Today is December 24th, 2025, and the precious metals market is standing at a historically important point. Gold and silver are not moving quietly anymore. They are sending strong signals to global investors, institutions, and long-term capital planners. The discussion going into 2026 is no longer about whether these metals matter, but about how much exposure is sensible at current price levels and how to structure purchases intelligently without chasing emotions or headlines. As of today, in the US market, gold is trading near the $4,490 to $4,505 per ounce range, while silver is trading around $72 to $72.3 per ounce. These are not normal prices by historical standards. Gold is sitting at record territory after a powerful multi-year advance, and silver has experienced one of its strongest percentage moves in modern market history. These prices reflect deep structural forces rather than short-term speculation. The global financial environment explains much of this movement. Over the past year, markets have been shaped by slowing economic growth in major economies, persistent inflation pressures, rising government debt levels, and increasing uncertainty around currency stability. When confidence in paper assets weakens, capital naturally looks for assets with long-term purchasing power. Gold has historically filled that role, while silver plays a dual function, acting both as a monetary metal and as an industrial input. What makes the current cycle unique is that both metals are rising together with strength. Typically, gold leads while silver lags. But in late 2025, silver has not only followed, it has accelerated. Industrial demand has been a major factor. Solar energy expansion, electric infrastructure upgrades, electronics manufacturing, and advanced technologies continue to consume increasing amounts of silver. At the same time, mining supply growth has struggled to keep pace. This imbalance has tightened the market significantly. Gold's rise, on the other hand, has been driven by capital preservation demand. Central banks, large funds, and private investors have increased allocations as interest rate expectations shift. With real yields under pressure and confidence in long-term currency purchasing power fading, gold has reclaimed its role as a strategic reserve asset rather than a speculative trade. Going into 2026, the most important question is not whether gold or silver will remain relevant. The question is how to approach buying them responsibly at elevated price levels. This is where the idea of optimal ounces becomes critical. Buying blindly at highs or waiting indefinitely for a perfect pullback are both flawed approaches. A structured method removes emotion and replaces it with logic. Optimal ounces do not mean maximizing quantity at any cost. They represent a balance between capital size, risk tolerance, time horizon, and liquidity needs. Someone allocating capital for long-term value preservation will approach ounces differently from someone seeking cyclical upside. Both approaches can coexist, but they must be clearly defined before any purchase is made. A practical starting point is allocation. Historically, gold tends to be more stable, while silver tends to be more volatile, but offers higher upside during strong cycles. Because of this, many investors lean toward a heavier gold weighting for stability and a meaningful silver allocation for growth potential. A commonly used framework is a 60% gold and 40% silver split within the precious metals portion of a portfolio. This ratio is not fixed or universal, but it reflects the different risk profiles of the two metals. Using current US prices, this allocation can be translated into ounces. For example, if an investor plans to allocate $10,000 into precious metals at today's levels, roughly $6,000 would go toward gold and $4,000 towards silver. At approximately $4,490 per ounce, $6,000 buys about 1.3 ounces of gold. At roughly $72 per ounce, $4,000 buys around 55 to 56 ounces of silver. These figures are not targets to hit immediately, but reference points to understand scale. Because prices are elevated, timing matters more than ever. Rather than committing all capital at once, a tiered purchase approach reduces risk. This means dividing planned purchases into multiple levels and buying incrementally as prices fluctuate. For gold, this might involve partial buys if prices dip toward the low 4,400s, additional purchases closer to the low 4,200s if volatility increases, and final allocations if deeper corrections occur. For silver, similar logic applies, with accumulation zones below current prices acting as opportunities rather than threats. This approach acknowledges uncertainty instead of fighting it. Markets rarely move in straight lines, and even strong long-term trends experience corrections. Tiered buying allows participation without overexposure at any single price point. Another important factor is liquidity. Gold and silver are liquid assets globally, but physical ownership requires planning. Storage, security, and ease of resale must be considered in advance. Investors should think about how quickly they might need access to capital and whether they are comfortable holding metals through periods of price volatility. These considerations influence how many ounces make sense on a personal level. Volatility management is especially important with silver. While silver often outperforms gold during strong cycles, it can also experience sharper pullbacks. This does not make silver inferior, but it does require realistic expectations. Anyone allocating to silver should be comfortable with price swings and avoid over-leveraging emotionally or financially. Looking ahead to 2026, several macro factors will continue to influence prices. Interest rate policy in the United States remains a central driver. Expectations of easing tend to support metals, while unexpected tightening can create temporary pressure. Currency movements, particularly the strength or weakness of the US dollar, also play a major role. A weaker dollar generally supports higher metal prices, while a stronger dollar can slow momentum. Geopolitical developments, supply chain adjustments, and fiscal policy decisions will also shape demand. These are not variables that can be predicted with precision, which is why flexibility matters more than forecasts. Owning optimal ounces is about positioning, not prediction. At current price levels, discipline is the most valuable asset an investor can have. Chasing momentum often leads to regret, while waiting endlessly for perfect prices can result in missed opportunities. A balanced approach accepts today's reality while preparing for tomorrow's uncertainty. As 2025 comes to a close, gold and silver are no longer fringe assets. They are central to serious financial planning discussions. The goal for 2026 is not to guess the top or bottom, but to build a position that aligns with long-term objectives and remains resilient across different market conditions. This is the foundation of an optimal ounce strategy. It is measured, flexible, and grounded in current market realities rather than emotional reactions. With this framework in place, deeper analysis of future scenarios, ratio adjustments, and long-term projections becomes meaningful rather than speculative. Continuing from the foundational analysis, the journey into 2026 requires looking beyond just current prices. Gold and silver are entering a phase where both strategic accumulation and tactical awareness matter. The main focus is understanding potential price ranges, market triggers, and how to adjust ounces dynamically as the year unfolds. Historically, precious metals experience waves of volatility, with each wave offering opportunities for disciplined investors. Starting with gold, current trading around $4,490 $4,505 per ounce represents a significant premium compared to long-term averages, yet it is justified by strong demand from multiple sources. Investors must anticipate that gold will not only respond to US interest rates, but also to global uncertainty, inflation expectations, and portfolio reallocations from equities and bonds. The optimal approach is to treat today's holdings as part of a multi-step accumulation strategy, gradually adding ounces if prices dip within predefined support levels, rather than attempting to time the absolute top or bottom. This approach protects against regret from both overpaying and missing opportunities. Silver, trading around $72 per ounce, carries an additional dimension due to industrial demand. Unlike gold, silver is heavily used in technology, renewable energy, and electronics. This creates a dual demand structure: investment-driven purchases and industrial consumption. This dual demand often results in amplified price moves, both up and down. Therefore, the optimal ounces for silver should be considered in light of expected industrial growth, seasonal demand fluctuations, and potential inventory changes in major consuming sectors. Fractional adjustments across months allow for smoother cost averaging, reducing the risk of a large allocation at a transient peak. A critical metric for investors is the gold to silver ratio, currently hovering near 62-63. This ratio, representing how many ounces of silver equal 1 ounce of gold, is historically high compared to long-term averages. Traditionally, a higher ratio indicates silver is undervalued relative to gold. Investors can use this ratio to calibrate ounce allocations dynamically, potentially favoring silver when the ratio is elevated and gold when the ratio is compressed. By using historical patterns, investors can build a balanced portfolio that benefits from relative value shifts between metals without relying on market timing. Risk management in 2026 should include awareness of macroeconomic factors. While gold often thrives in periods of uncertainty, it can experience temporary retracements when markets anticipate rate hikes, stronger dollar movements, or economic stability. Silver's volatility amplifies these effects, meaning that planned ounces may fluctuate in paper value even without actual sales. Accepting this reality allows investors to maintain positions without panic, emphasizing that short-term swings are part of the broader investment journey. Liquidity and storage remain practical considerations. Physical metals require secure facilities, whether at home safes, bank vaults, or third-party custodians. For those accumulating multiple ounces, proper organization and insurance are essential. The objective is not merely ownership, but readiness to transact efficiently if market conditions demand. Looking forward, scenario planning is valuable. A base case assumes continued moderate economic uncertainty and stable demand, suggesting gold may trend toward $4,900 per ounce and silver above $80 per ounce by the end of 2026. In an optimistic scenario, accelerated industrial adoption of silver in technology and energy, combined with gold's safe haven appeal during potential market volatility, could drive silver beyond $85 and gold toward $5,100. Even in a conservative scenario with temporary market retracements, ounces accumulated across tiers provide resilience, allowing investors to average prices without panic selling. For practical implementation, tiered purchase plans remain critical. Investors should define initial accumulation zones for both metals and monitor market activity closely. A common method is to divide planned purchases into 3 to 5 tranches, incrementally increasing ounces as prices fluctuate within predetermined bands. This method reduces emotional decision-making, ensures cost averaging, and aligns holdings with realistic market behavior rather than speculative forecasts. Additionally, the interplay between investment motives and market liquidity should guide ounce decisions. Those focused primarily on long-term value may hold larger allocations, while investors aiming for tactical exposure can maintain smaller, flexible positions. By scaling ounces according to personal financial capacity, risk tolerance, and liquidity needs, investors remain positioned to benefit from market trends without excessive concentration risk. As 2026 progresses, it is advisable to continuously reassess optimal ounces. This includes tracking global economic indicators, central bank announcements, inflation data, and currency movements. Even modest shifts can influence both metals, and staying informed ensures ounce allocations remain rational. Investors should avoid overreacting to temporary volatility while remaining attentive to structural changes that could alter supply-demand dynamics. Finally, understanding the broader context is essential. Gold and silver are part of a diversified strategy, complementing other asset classes. Ounces are tools, not goals. They represent purchasing power preservation, portfolio stability, and a hedge against uncertainty. Success in 2026 will come from disciplined accumulation, informed adjustments, and a clear framework that defines how many ounces are reasonable at current and future price levels. By adhering to this approach, investors maintain exposure to precious metals' upside potential while managing risk and avoiding speculative extremes. In summary, the optimal ounces for 2026 depend on current price reality, allocation preferences, tiered accumulation strategy, industrial demand for silver, gold-to-silver ratio analysis, and ongoing monitoring of market and macroeconomic trends. Structured planning ensures that each ounce acquired serves a strategic purpose, balancing opportunity with prudence and positioning investors to benefit from both growth and stability in the evolving precious metals market.